Hi guys, welcome back. In this video, we're going to be doing the topical MCQs for national income statistics. Now, before I proceed with this video, I'm making two assumptions. Assumption number one, that you already have basic knowledge on this topic. And the second assumption is that I am assuming you've already gone through my videos on gross national income and net national income that are already on my AS macro playlist. If you haven't already, then first go through those videos and then come back to this video. Let's get started now. Question number one says, what cannot be measured to find a country's GDP, expenditure, income, output, wealth? So the correct answer to this would be D for David, wealth. Why? Because A, B, C are all measures of GDP. They're all measures of GDP, right? And basically there are different ways of measuring what is produced in a country. In contrast, wealth is a stock of assets that have been built up over time. So the correct answer to this MCQ is David. Question number two says, what is included in net property income from abroad? Net property income from abroad is basically, added to your GDP to arrive at GNI. Now, we don't just add the property income, the net property income, but we also, so basically we add the net factor income, or you can say net income. And that includes basically the compensation of the employees as well, and that includes the net factor includes the net factor income or the net income from abroad. When we add the net income from abroad to GDP, we basically arrive at GNI, right? And the net income from abroad or net factor income from abroad includes your compensation. It includes your compensation of employees. It includes your interests, basically. It includes your dividends and your profits as well, right? So all of this is included in net income from abroad. And basically your net property income, that is your net property income from abroad, is taking into account your interest, dividends and profits. So when you're referring to net property income from abroad or net property income, you're referring to interest, dividends and profits, right? We add and subtract the compensation of employees separately, but all of this is classified under net income from abroad, and then it is added to the GDP to arrive at GNI. And hence it follows that the correct answer to this question would be B, that is interest, because net property income from abroad includes interest, profits and dividends. So basically net income from abroad is a broader measure that includes not only the net property income from abroad, but also net compensation of employees as well. So basically it encompasses all the forms of income that a country's residents receive from foreign sources, minus the income that foreign residents receive from the country's domestic sources. Question 3 says, what must be zero if GDP at market prices is equal to GNI at market prices, right? Now, the correct answer to this question should be B, that is net property income, because net property income is included in GNI, but not GDP, right? And if there is no property income from abroad, let's say there is no property income from abroad, then, the two measures would be equal. That is GDP at market price would equal your GNI at market price, right? And both these measures, I think GDP at market price and GNI at market price, both these measures are basically adjusted for indirect taxes and subsidies. So A and C is not the correct answer, right? And so transfer payments are basically not included in either measures, right? So that is what makes B the correct answer. Question number 4 says the table shows some national income statistics. This is a very interesting question. It gives us a table and you have some values. You have GNI at basic prices, indirect taxes, net income from abroad. It says, what is GDP at market prices? First, let's understand the concept of basic prices and market prices. Firstly, you need to understand that whenever you're given with GDP at basic prices, it is simply GDP at factor cost or GDP at basic prices. And there's a difference between in national income accounting or national income statistics when we use basic prices versus what do we mean by market prices. And the term basic prices is used in the national income statistics or national income accounts to refer to the prices of the products as received by producers. And I'll explain it to you. Well, market prices are the prices as paid by consumers. So when your GDP is measured on the basis of market prices, that is when you have a GDP that is valued at market prices, it automatically factors in all those factors that would affect the market price of goods and services across the economy. And what could that possibly be? That is obviously indirect taxes and subsidies, because that would have an impact on market prices as well. So the market prices would not just reflect the value added or the value of the production itself, but would also reflect the how the taxes would increase the value in terms of the price, and how subsidies would reduce it. Because the key difference is that the market price is referring to the price that is paid by the consumer, versus basic price is the price that is received by the producer. Now, first, what we need to do is that the first step, they're asking us what is GDP at market prices, right? So first, we are given with GNI at basic price, and we're also given net income from abroad. So first, we need to convert the GNI at basic price to GDP at basic price. And the formula for GNI at basic price is that GNI at basic price equals to GDP at basic price plus net factor income from abroad, right? However, GNI at market price would be GDP at market price plus net factor income from abroad, right? So GNI at basic price is 500, while net factor income from abroad is 20. So the difference would reflect the GDP at basic price. And if you deduct 500 from 20, you will get basically 480, which is your GDP at basic price, right? $480 billion. And so if you want to convert it to GDP at market price, you need to add indirect taxes, because adding the tax would increase the price, because market prices, that when you are measuring something at market prices, you're taking into account the prices that's paid by consumers. And if you're measuring the entire GDP on market prices, it means that the GDP factors in the GDP is valued at market prices, which obviously reflects the price which is paid by the consumers. So indirect taxes would add that price, it would increase the price. So we will basically add up indirect taxes of 40, and subsidies would reduce the market price, hence we'll deduct 20 from here. And hence we'll arrive at GDP at market price, which should be 510. So the correct answer should be C for Charlie, $510 billion. And this is actually the main formula that you need to learn. And that is that GDP at market price, you add indirect taxes to it and you deduct subsidies from it to arrive at GDP at market price. And if, let's say, in the question you are already given GDP at market price and you want to arrive at GDP at basic price, you will work backwards. If you're going from here till here, you will add indirect taxes, deduct subsidies. If you're working backwards, you're going from GDP at market price to GDP at basic price. You'll basically add up subsidies and then you'll deduct the taxes. Question number 5 says, what would it mean if GDP at basic price is of higher value than the GNI at basic price? Now we know that GNI at basic price equals to GDP at basic price plus net factor income from abroad. And if your GDP at basic price is higher, so it means that, for example, let's take a numerical value. Let's say GNI at basic price is let's say 80, while GDP at basic price is, let's say, $100. So it means that the net factor income has to be negative then in that case, right? The net factor income would be negative 20, right? So net factor income negative 20 basically means that your negative net income or net factor income, or let's say net income from abroad, basically, we're talking about net income from abroad is negative. It means that a country is paying more to foreign residents for their investments and labor within the country than it is earning from its own residents, investments and labor abroad. And so the correct answer, it follows that the correct answer for this should be that your net income from abroad is negative, but you should know the meaning of net income abroad being negative. Now let's do question number 7. It says an economy's GDP is 640 billion, its consumer expenditure is 490 billion, its government spending is 100, its investment is 80 billion, and exports are 50, and you want to find the value of the imports. And now we know that GDP, since you have expenditures given and then you have GDP given, so we are implying that we're calculating GDP based on expenditure method. And in either case, whatever method of GDP calculation we use, we all arrive in theory at the same figures. And so if the economy's GDP is, let's say, 640 billion, we know that GDP that is spending based for a given year is calculated by adding up the spending that is going to take place to purchase the final output that is produced in that year. And total spending on the final output is expressed as the expenditure or spending that is done by in the form of consumer expenditure, government spending, expenditure, investment spending, and net export spending. And so what it follows is that the GDP of 640 billion that is spending based is equal to the amount of consumer spending, the amount of government spending, which is 100 billion, the amount of investment spending, and the amount of net export spending, which should be plus 50 minus your net export spending, that is M, right? And so it follows that if you calculate the value of your imports, you just need to add all these numbers up and deduct it from 650. So 490 plus 100 plus 80, 490 plus 100 plus 50 and 80 minus 640 should then give you an imports of $80 billion. So 7 should be D for David, right? Question number 8 says, what would NNI at basic price, how would NNI at basic price be converted to GDP at market price? So basically, you need to understand that if you have your net national income at basic price, right? You have your NNI at basic price, and you need to finally find your way to GDP at market price, right? And so it follows that if you have NNI at basic price and you add depreciation to it, you will get GNI at basic price, right? Because you see, when you want to convert your GNI to NNI, right, you deduct depreciation. And if you want to convert your NNI to GNI, since depreciation is already deducted and factored in, the amount of depreciation is deducted when you arrive at NNI. So in order to arrive at GNI, you will add that again, right, and to NNI, and then you arrive at your gross national income. And since your net national income is right now measured at basic prices, so if you add depreciation, you will automatically arrive at gross national income at basic prices. And so it follows that if you already have your GDP at basic price, in order to arrive from GDP, you want to arrive to if you want to arrive from GDP to GNI, right, you basically add your net factor income. And if you have your GNI given and you want to arrive at GDP, then you will deduct your net factor income. You'll work backwards. So you deduct your net factor income from your GNI at basic price, and then automatically you'll arrive at GDP. But since GNI was measured at basic prices, so the value that you will arrive over here would be at basic prices. You will arrive at GDP at basic prices. Now, in order to convert your GDP at basic prices to GDP at market prices, you need to add your indirect taxes and you need to deduct your subsidies, right? Because your GDP at market prices would be reflecting it would factor in what consumers are paying, right? Like I told you at the start of the video as well. And so it follows that you're adding depreciation, you're deducting net factor income, you're adding taxes, and you're deducting subsidies. So A should be the correct answer for question 8. Okay, let's do the next question. Question number 9. I feel you can do the question 9 on your own as well, because by now we've done the similar questions. Question 10, let's do question 10. Why may the output of image processors used in the production of smartphones in a country not be included in the calculation of GDP? Okay, so the output of the image processors, and the output is used in the production of smartphones in the smartphone industry, means that it is acting as a raw material or input to smartphones, right? And so the correct answer to this question should be C, that the value of image processors is included in the value of the smartphones produced. Why? Because you see, in calculating the GDP by the output method, it's very important that we avoid double counting. So measuring the value of the finished products, that is, would mean that because smartphone is your final output, so if for example the output of the image processors is, let's say, $10, while the, let's say, and so technically what we need to do is that this would represent the value added as well. And while let's say the final value or the final output of the production of smartphone is valued at, let's say, $20, so this $20 includes the $10 that is the output from the image processing industry, right? And so measuring the value of the finished products would mean that image processors would already have been counted in the output of the smartphone industry, right? So we want to avoid the double counting then. So the value of the image processors is included in the value of the smartphone industry. And so to avoid the problem of double counting, economists basically use this concept of value added. So each firm's value added is the value of its output minus the value of the inputs that it purchases from other firms, which were in turn the output of those other firms as well. So for example, a steel mill's value added is the value of its output, the steel mill's output, minus the value of the ore that it buys from the mining company, and also minus the value of the electricity and fuel oil that it uses, and the value of all the other inputs that it buys from all the other firms. Right? Similarly, a bakery's value added is the value of the bread and the cakes it is producing, minus the value of the flour and the flour and all the other inputs that it buys from all the other firms. So the value added basically measures each firm's own contribution to the total output, right? The amount of it reflects the amount of the market value that is produced by that particular firm. So its use is to avoid the statistical problem of double counting, basically, right? And so the sum of all the values that are added in an economy is basically a measure of the economy's total output, right? And exactly that is why the value of the image processors is included, and basically that is why we're saying that the value of the image processors is included in the value of the smartphones produced. And if you want to just find out the value added by the smartphone production or by this particular smartphone manufacturing company, you need to take out the final value of the smartphones, and you need to deduct the output value of the image processors, which are acting as inputs to the smartphone manufacturers, right? Okay guys, moving forward, another question says the government's statistical office measured the changes in income from employment, pensions and benefits, and then it subtracted. Okay, so basically it added up the incomes from employment, the pensions and the benefits, and then so technically when it did that, when it's adding up all the income from employment and the money that you're receiving from pensions and benefits, so basically you're calculating personal incomes. You're adding up all the incomes in different forms, and then you subtract the income tax from it, right? And you also subtract welfare contributions, right? So when you subtract the welfare contributions, because when you subtract the income tax or the welfare contributions that are being made, the social security welfare contribution, so that would reduce the income, right? And the income tax would reduce your disposable incomes as well. So when you subtract that, you arrive at disposable income. But when you adjust the disposable income for inflation, you are actually seeing, because disposable income refers to the personal disposable income is referring to the amount of income that is available for spending or saving. And when we adjust that for inflation, we actually see that what is the buying power of that disposable income, right? And so that is why, so we end up with real disposable income. So when we're adjusting it with inflation, we are valuing real disposable income, or we are calculating real disposable income, which is what we're seeing is that, okay, fine, if this much is our disposable income, then in real terms it's actually worth this much or that much. So the correct answer to this question should be C, that is changes in the real disposable income. The next question says what the value of net property income from abroad is negative. What can be deduced from this? The correct answer to this question should be C, that is gross national product at factor cost is at factor is less than the gross domestic product at factor cost. I mean gross national product at factor cost basically. And the reason is that, first of all, so GNP at basic price, which is actually GNP at factor cost, basic price and factor cost are the two words that could be used interchangeably, equals to your GDP at basic price plus net factor income from abroad, right? And so it follows, I think this is the same MCQ we did before as well, that if your net property income is basically negative, you have negative here, net factor income, so it will reduce and bring your GDP value down, and basically your GNP would be less than your GDP, right? So this is a simple question. I mean you just need to know that don't freak out when you hear the word factor cost. Factor cost is simply referring to when your GDP is measured at factor cost, it's simply referring to GDP at basic prices, or GNP at factor cost is simply GNP at basic prices, right? Okay guys, moving forward, the next question, let's do question number 4. It says, and this is a very interesting question, I want you to pay very close attention to this, okay? The gross domestic product of a country is 300 million and the price index stands at 150, that is your CPI. What is the country's gross domestic product that is valued at the prices of the base year of the price index? Simply they're asking us to calculate real GDP, that is they want us to deduct the inflation from our GDP that is measured. This because this is the nominal GDP, right? 300 million. Because it says that the price index stands at 150. So you have the effect of inflation in it, and hence we are supposed to deflate that GDP. So what we need to do is that we need to calculate or come up with a GDP excluding the impact of inflation in it. And so economists use the GDP deflator for that. The GDP deflator is simply, it helps to measure the overall level of inflation in the economy by comparing the current level of prices to the level of prices in the base year. So if your current price index is 150, and if we compare it to the price index of the base year, it's simply telling us that the price level has gone up by 50%, right? So for such questions, guys, there are 4 key formulas that you need to know. So for example, if you were to calculate real GDP, so the first formula is that the real GDP equals to nominal GDP divided by the GDP deflator. Now we have the nominal GDP given 300 million, but what's the GDP deflator? We need to find that out. And for a GDP deflator, we use the formula CPI, that is current year, divided by the CPI of the base year. The third formula is that we could also basically calculate real GDP by multiplying the nominal GDP with the CPI of the base year divided by the CPI of the current year. Now, CPI of the base year divided by the CPI of the current year is basically the inverse of the GDP deflator. You can clearly see that CPI base year, so for example, your GDP deflator is CPI current year divided by your CPI in the base year. And if you inverse this, that is you basically 1 upon your GDP deflator, right, would basically be equal to this value. Right, so basically it follows that your real GDP is simply your nominal GDP multiplied by the inverse of the GDP deflator. That is nominal GDP. So this formula of real GDP, is consistent with this formula of real GDP that says real GDP equals to nominal GDP multiplied by 1 over the GDP deflator, right? So now you have the formulas in front of you. Let's plug in the values and see. So real GDP would basically be nominal GDP divided by the GDP deflator, and GDP deflator is 300, basically CPI of the base year, CPI of the current year divided by CPI of the base year. Now the base year CPI is 100, and remember that in the base year your inflation rate is 0. So CPI of the base year is 100 and CPI of the current year is 150, right? So GDP deflator would be 1.5, right? 150 divided by 100 would give you 1.5. And hence now what you need to do is that you have your GDP deflator with you, and if you divide 3000 by the real GDP formula for real GDP is nominal GDP divided by the GDP deflator, right? This. So your nominal GDP is 3000 divided by 1.5 would give you the real GDP of $2,000 million, right? And so you could either use this formula or you could use this formula as well. Nominal GDP multiplied by CPI of base year upon CPI of current year. That is 3000 times CPI base year is 100 divided by 150. So 3000 multiplied by 100 over 150 would again give you 2000. And like I said, 100 upon 150 is simply the inverse of the GDP deflator. So the value of 100 divided by 150 is simply 0.66667, while the inverse of the GDP, and the GDP deflator was 1.5. And if you inverse it, that is 1 upon 1.5 would also give you the same value, 0.66667, right? And so real GDP equals to nominal GDP times the inverse of deflator. So nominal GDP is 3000 multiplied by the inverse of deflator, that is 1 upon 1.5. So if you input these values, 1 upon 1.5, so the answer would be 2000. So 2000 is basically the correct answer, which is your country's gross domestic product valued at the prices of the base year of the price index. It simply means they're asking you to calculate your real GDP deducting the effect of inflation, right? So that makes B 2000 million the correct answer. The next question number 5 says the table shows changes in the population, price level, and GDP. So you have your population is given in year 1, year 2, your CPI is given year 1, year 2, nominal GDP is given in year 1, year 2. What happened to real GDP and real GDP per head? Okay, so firstly, let's see what happens to real GDP. And when your CPI is 100, so year 1 is your base year, and year 2 is your current year. Then, so basically, so let's find out the real GDP in your base year. Now, the real GDP in your base year would be equal to the nominal GDP, because in the base year, when your CPI is 100, you don't have any inflation. So your real GDP will be equal to your nominal GDP. But still, let's prove it from the formula as well. So your real GDP, nominal GDP is what? Nominal GDP is 400 times CPI in the base year is 100. So the CPI in the current year would be equal to the CPI in the base year, because the base year is the current year for that base year. So 100 over 100, which simply means your real GDP is 400 as well. So your nominal GDP in the base year is also 400, and your real GDP in the base year is also 400, because obviously theoretically it was obviously as well, economically as well. I mean, we didn't really have to go through this formula, but still, like, I just wanted to prove it. Anyways, let's calculate the real GDP in year 2. So this is year 1, which was your base year. You're done with the real GDP in year 1. Let's calculate real GDP in year 2, and that would be nominal GDP 480 multiplied by CPI in the base year is 100 divided by CPI in the current year is 120. So basically 480 multiplied by 100 over 120 should give you 400. And it means that our real GDP in year 2 is 400, and we can see that the real GDP in year 1 is also 400, while year 2 it's also 400. So there's no change. So the answer is either A or B, but let's see what happens to real GDP per head. Real GDP per head is simply your GDP, real GDP per capita. Real GDP per head simply means average incomes per person, real average incomes per person. That is how much on an average does a person earns in a year. That is your real national income per person, right? So real GDP per head would be your real GDP divided by population. So your real GDP, the formula is real GDP per head is basically real GDP. The formula is real GDP divided by the population of the country. And so real GDP in your year 1 is basically how much? It's 400 times divided by the population, which is how much? Which is 50. So 400 divided by 50 would give you 8, right? And and your real GDP in year per capita in year 2 would be 400 divided by 55, which is 400 divided by 55, which is how much? Which is 7.3. So it means that your real GDP per capita is falling, right? So answer should be A. That is, real GDP remains the same, but real GDP per capita fell. Okay guys, the next question is interesting. The next question says the table gives information about two countries in 1994 and 2004. Now there's a lot of information given in the question and my working as well, so I want to play. So let's sort of go through it slowly and slowly. So let's step by step. Basically, from the table, data in the table, what can be concluded about real GNP per head? So firstly guys, see, real GNP is another word for GNI. So it's saying real GNP per head is similar as saying real GNI per head. So that doesn't really matters. Whenever the word per head is used, you're talking about per capita, that is per person. So you need to divide it by population. Whether you're calculating GNI per head, GNI divided by population, GDP per head, GDP divided by population, GNP per head, GNP divided by population. Okay? And understood? Real GDP per head, real GDP divided by population. Real GNI per head, real GNI divided by population. Real GNP per head, real GNP divided by population, right? So let's see what's happening here, okay? So for country 1 in 1994 and for country 2 in 1994, the GNPs are given in 1994 and for 2004 in country 1 and country 2 respectively. Then you have the populations given, and then you have the price indices given. So the price index is given. Not the price indices, the price index is CPI given, right? Anyways. So now what happens is that the formula for real GNP per head is real GNP upon population, right? But we don't have the real GNP given. We have the GNP given at nominal values. That is, they're saying at local currencies. Local currencies means your whenever the word local currencies is used, it's talking about GNP at nominal values basically. So we need to find the real GNP, and to find the real GNP, we'll use the formula nominal GNP times CPI of base year upon CPI of current year. So let's find out. 1994 is our base year, by the way. So the GNP would be the same as real GNP for 1994. But anyways, the real GNP would be 5,000, that is nominal GNP, times CPI in base year upon CPI of current year. That would be 100 over 100, and that would equal 5,000. So the real GNP in 1994 would be 5,000, and the real GNP per capita would be 5,000 divided by population, right? So the population in 1994 in country 1 is 5,000. So 5,000 upon 5,000 would give you 1. So that's your real GNP per capita in country 1 in 1994. Then let's see what happens in 2004. So in 2004 in country 1, the real GNP would be calculated by using the formula nominal GNP multiplied by CPI of base year divided by the CPI of current year. So you need to learn this formula. It should be on your head at all times when you see such MCQ. So real GNP in 2004 for country 1 is 18,000. That is your nominal GNP. So it would be nominal GNP, that is 18,000 is your nominal GNP, multiplied by CPI of base year 100 divided by CPI in 2004 in country 1 is 300, 100 upon 300. So real GNP in 2004 for country 1 is 6,000, and you divide it by the population 5,500, you get the real GNP per head, that is 1.09. And we can see that the real GNP per head in country 1 from 1994 to 2004 has gone up. So it's gone up from 1 to 1.09. Anyways, let's do exactly the same for country 2. For country 2, the real GNP in 1994 would be nominal GNP times your CPI and base year over your CPI and current year, and that would be equal to, so real GNP would equal your nominal GNP, that is 10,000. 10,000 times 10,000, your nominal GNP for 1994 in country 2 multiplied by 100 over 100 would give you 10,000. So that's your real GNP for country 2 in 1994 divided by the population, that is 3,000 in 1994 for country 2, and you get 3.3 as your real GNP per capita. And then for 2004, your real GNP would be nominal GNP times CPI base year over current year CPI, 100 over 200. 100 was your base year CPI or current year CPI in 2004 for country 2 is 200. 100 over 200 times 20,000 would give you 10,000 as your real GNP. You divide this value by the population, which is 3,300, you get real GNP per capita, that is 3.03, and you see that the real GNP per capita in country 2 in 2004 has gone up as compared to 1994, that was 3.3. So the correct answer for this question, it has gone down, my bad, it has gone down to 3.03 from 3.3. So 3.3, it was 3.3 in 1994, while it's 3.03 has gone down in country 2 in 2004. So the correct answer is A, it fell in country 2 only, because the reason is that real GNP per capita rises in country 1 while it falls in country 2. In country 2 it falls, right? So it's rising from 1 to 1.09 and it's falling from 3.3 to 3.03. Right, guys? Okay, guys, now moving on to the next question. Question 7 says the table gives data for an economy. You have GDP given at current prices in billion of dollars, and you have the GDP deflator index given. In which year did real GDP decline compared to the... Okay, so first of all, see, GDP deflator by... basically the GDP deflator could also be expressed in index form, and ideally the GDP deflator is an index because it measures the change in the overall price level of all the new and domestically produced final goods and services in an economy over a specific time period. So for example, like over here, for example, in this formula that we had used, if we divide CPI of current year divided by CPI of base year, so for example, if the CPI of current year was 150 over 100, we get 1.05. But 1.05 with the GDP deflator, this could also be expressed as an index. That is, we could say 105, right? And 1.2 GDP deflator value could be expressed as an index as well. We could say 102, right? So GDP deflator is actually which was a question, yeah. So the GDP deflator is basically an index as well. It is basically a price index that reflects the average level of prices of all the goods and services, right, that are included in the GDP calculation. And so I'll mention another formula for GDP deflator, that is GDP deflator. You calculate GDP deflator like this as well, equals to nominal GDP divided by your real GDP times 100. Now times 100 is not percentage. Times 100 is just we're converting the GDP deflator value, we're writing it as an index number, right? So for now, let's do this question. So we need to calculate the real GDP first, and then we'll see when did it decline. So first calculate real GDP, then we'll see when did it decline, right? So real GDP equals to nominal GDP divided by, so GDP deflator is given as 100. Okay, so first of all, another thing, that if we interpret these values, I mean, whenever we interpret the GDP deflator value, so a GDP deflator value of 100 indicates that the price level has not changed from the base year. It means zero inflation. So GDP will actually, this GDP, which is your nominal GDP, will be equal to your real GDP as well. And a GDP deflator value which is greater than 100, let's say 109, indicates that the price level has increased, since the base year. So you have inflation. And a GDP deflator value of less than 100 will indicate that the price level has decreased since the base. So let's say you have a GDP deflator given as, let's say, 95. So it is indicating that the price level has decreased since the base year. So there's deflation, right? Although you don't have deflation here in this case because all the GDP deflator values are more than 100, the GDP deflator indexes. Anyways, so GDP deflator equals to nominal GDP upon real GDP times 100, 100 being the index, converting it into an index. And so what happens is that your GDP deflator is given as 100 here. So let's calculate real GDP, right? So for the base for 2000. So for year 2000, if you were to calculate the real GDP for the year 2000, it would be using this formula. GDP deflator equals to 100 divided by nominal GDP is 200 divided by your real GDP, which is X, times your 100. And so the value of your real GDP, which is X right now, would be how much? Would be basically 200 times your 100 divided by, it will be 200. Like I said, the real GDP would equal your GDP if there's no inflation. When the GDP deflator is equals to 100, the index equals to 100, it means there's no inflation, and so GDP, real GDP are the same. Then you have a value of how much you have, the GDP deflator 109, so 109 equals nominal GDP is 220 divided by X times 100, and so the value would come up to 220 times 100 divided by 109. The value would come to 201. And then for this particular year, for year 2002, you will write 118 equals to your nominal GDP, that is 240 divided by real GDP into 100. And so the answer should be 203. And then, so these are your real GDP values, right? And so your real, and for 2003, it should be 149 equals to nominal GDP 300 upon X times 100, X being your real GDP because that's what you need to find. 300 times 100 divided by 149 should give you 201. And then for this particular year, 2004, same thing, 154 equals to 320 upon X times 100. That X being the real GDP in 2004, 320 times 100 divided by 154 should give you how much? Should give you 207. And what it follows is your real GDP is going up, right? Except for 2003. So 200 to 201, 201 to 203, 203, it then fell to 201, and then it went up to 207. Again, so in which year did real GDP decline? It declined in 2000 compared to the previous year. So compared to the year 2002, in which the real GDP was 203. In 2003, it declined to 201. So the answer is C, that is 2003. Right, according to the table, the real GDP declined in 23 compared to 2002. Okay guys, let's move on to the next question. Let's do question number 10. It says the real national income of a country fell by 3%. What could have caused this? Now the real national income is basically it's basically income that is adjusted by inflation. And when it says your real national income is falling by 3%, it's simply telling us that, your real output that is measured or adjusted after inflation is basically going down by 3%. And this suggests that your rate of inflation will definitely be, the rise in the rate of inflation would definitely be more than the rise in your nominal or your money national income basically. So your money nominal national income is your total income of a country which is measured at your current prices which have not been adjusted for inflation. While your real national income is your total income of a country that is adjusted for changes in the price level, that is inflation. And so the correct answer for this would be C, because when the money national income will rise by 3%, right? At the same time, when the rate of inflation is going up by 6%, so it follows that when your money national income will rise by 3%, it means that your nominal income, your nominal GDP rises by 3%, right? But at the same time, since your inflation is rising by 6%, since it is rising by more than your increase in nominal income, so your real GDP or your real national income would actually decrease here, because the inflation rate here is higher than the nominal, income growth rate. So your percentage change in real income, or real GDP, or percentage change in real GDP or real national income, they both mean the same thing, would equal your percentage change. Okay, so let me write it neatly. So sorry guys, your percentage change in your money income minus your inflation rate. Inflation rate is simply percentage change in the CPI, that is your price index. So it follows that if your percentage change in real GDP or real national income is over here is falling by 3%, so it's negative 3%. So it means that the change in your money national income would be plus 3% minus your inflation rate is 6%. And so it follows that the correct answer would be minus 3%, which matches this, right? Which is given in the information. And so that is why the correct answer is C. Money national income rose by 3% when the rate of inflation was 6%. Question number 11 says, during 1 year, the national output of a country valued in terms of money prices increased by 8%, while the index of the prices of all the goods and services produced increased by 3%. Index going up by 3% means that your CPI, the inflation rate measured by the calculating the differences in the CPI is going up by 3%. So for example, if the base year is 100 and your inflation goes up by 3%, so the CPI of the current year would be 103, right? And so by how much did your real national output change or increase? And like I just said, you use the same equation, that the percentage change in your real GDP or your real national income or your real national output. These are the three words that are used interchangeably in national income. That is real GDP, national income, or your real national output, or real GDP or real national income, or your real GDP or your national income or your national output. They are the same. So so how much did real GDP output increase? So the percentage increase in your or the change in your real GDP or real national output would be the percentage change in money income, and it says that the percentage change in money income is 8% minus the inflation rate, and the inflation rate over here is minus 3%, and so it went up. How much did real national output increase? The real national output went up by 5%, and so the correct answer to this question should be 5%. That is B. Right? By how much did your real output increase? It basically went up by 5%. So this is the formula that you need to use. Percentage change in real GDP or real national income equals to the percentage change in money income minus your inflation rate. And so it follows here you see there is your real GDP is going up by 5%, or the real national output going up by 5%. Why? Because the inflation rate is the percentage change in your price level, or the percentage change, that is your inflation rate, the percentage change in your price level, or the rate at which your general price level is going up, is less than your the rate at which your nominal income or your money income is going up, right? And so it follows that your real GDP is hence going up by 5%. The next question says, during a year, a country's national income in money terms increased by 5%, prices went up by 4%, total population went up by 2%. What was the approximate change in real income per head, per capita, that is per capita? Now, you need to understand that your real national income growth, that is your growth in your real national income, which is the percentage increase or decrease in your if it's a negative growth in your real national income, it factors in or takes into account or adjusts the effects of inflation. And so it follows that your real national income growth would be your percentage increase in the national income, that is your money national income, that is 5%, right? Minus you'll factor in inflation, you will adjust that, minus your price level that went up by 4%, right? So it means that your real national income growth, again I'm repeating, real national income growth is going up by 1%. But when you want to know an approximate change in your real national income per head, so now you know that your real national income or your real GDP is going up by 1%. But what would be the change? If you want to calculate the change in your real income per head, then you need to understand that real income per head would consider or factor in not only the real national income growth, but also the population growth. And now we know that the population growth is going up by 2%. So if your real national income is going up by 1%, but your population is increasing by 2%, it would bring down your real income per head. So your change in your real income per head would basically decrease by 1%, right? Your real income per head would go down by 1%, because although your real income is going up by 1%, but since the population is increasing by 2% as well, so your real income per head, the approximate change in your real income per head would be that it will decrease by 1%. That is what makes A the correct answer. Let's move on to the next question. It says, question 14, over a given period, the nominal value of a country's income, basically national income, increased by 20%, the rate of inflation was 10%. So if your nominal income is increasing by 20%, but the rate of inflation is 10%, so your real increase in your real GDP or real national income is going up by 10%, and a rise in your real GDP or your real national income after basically adjusting for inflation is representing the actual increase in output, is telling us that, okay, fine, if you're because you see, when your national income is going up by 20%, not all of that increase in national income is because more output was produced, because you're measuring your national income at your current price level. That is, it is measured at your market prices. When you measure national income at your market prices, it includes the effect of inflation in it, because market prices are inflated, right, because of inflation. And so deducting that effect of inflation, or factoring in adjusting for that effect of inflation would lead you to arrive at a value that truly reflects that how much of that increase in real GDP, how much of that increase in your GDP or national income is attributing or accrues to the increase in real output or increase in actual output, in terms of an increase in production taking place. And that increase in production is creating more value to the economy's GDP rather than inflation. And deducting that effect of inflation would give you the real increase in national output, or what your national income or real GDP is going up. The real increase in GDP because of the increase in output, or the increase in GDP because of is not 20%. That is, increase in GDP because of the increase in output is not 20%, but the increase in GDP because of the increase in output is only 10%, while the other 10% reflects the increase in inflation or the increase in prices, which is inflating the GDP values, right? So the correct answer for this should be A. There was an increase in the volume of output, because it means that more production took place, and that increase in production contributed or added value to the increase in GDP. So that 10% increase in GDP. That 10% increase in GDP is coming from the increase in the volume of output that has taken place during this year, that has contributed to the increase in your country's GDP. And that is what is the increase in real GDP, basically. That how much of the increase in GDP is attributing to the increase in the volume of output. Okay guys, question 15 says, between 2008 and 2009, the country's national income at current prices increased by 15%. At the same time, the country experienced 5% inflation. Which index number most closely represents the country's national income in 2009 at 2008 prices? So country's national income in 2009 at 2008 prices means in 2008 index is 100, which means that 2008 is the base year, because its index is 100, so the CPI is 100, which indicates that is a base year, and in base year there is no inflation, there is zero inflation. And so if we want to calculate the country's national income for 2009 but at 2008 prices, that is at base year prices, it simply means that we are trying to exclude the effect of inflation. Right? So which means that, the country's national income is in 2009, we try to measure the country's real national income in 2009, basically real national income in 2009, or we are trying to measure the real GDP in 2009. How do we know that we are trying to measure the real GDP in 2009? Why? Because it says measure the GDP or the national income in 2009 at 2008 prices. And we know that the 2008 price index is 100, which means it is a base year. So basically what we need to do is that we are trying to find not the nominal GDP for 2009, but the real GDP for 2009, because we want to deduct the effect of inflation. We want to reduce or minus the effect of inflation from it. And how do we do that? We know that the country's national income has gone up at current prices. That is, it's talking about the money national income or the nominal GDP or the national income, because it's measured at current prices. It increased by 15%. And so the inflation rate is 5%. So it means that the real national output or real national income goes up by 10%. And so guys, it follows that if your real GDP is going up by 10% and you want to basically measure the 2009's GDP in real terms, and you want to associate an index to it. So if your real GDP is going up by 10% and you want to basically convert it into an index form, and you want to say, okay, fine, in 2009, what would be an index that would very closely reflect the real GDP compared to the base year's index, which is 100. So it would be basically 110, right? So guys, it follows then that if your real GDP is going up by 10%, right, and you want to find out that, you know what will be your country's real national income in 2009, because it's saying national income in 2009 measured at your 2008 price level, at 2008 prices. Okay, fine. If your real GDP is going up by 10%, so what is the index number that very closely reflects that? So let's say that the real GDP, if your real GDP index in 2008, let's say, was 100, because this is an index number, right? So let's say that your real GDP index in 2008 was 100, because that's a base year, because assuming that you didn't have any inflation, right? So whatever your GDP was, that was your real GDP as well, and hence we associate an index number associated to it, and that is why we give it an index of 100. So basically, the real GDP in 2009 would be 100 plus 10, that is 110, and that makes the answer B, right? Which simply means that if my base year index is 100, and if let's say the next year my real GDP is going up by 10%, so the next year's index would be 110 in that particular year, reflecting a 10% increase in real GDP compared to the base year. So that's it, guys. Now I will be ending the video here. I hope you enjoyed this video, and I'll see you all around in some another topical video. Until then, take care.